Welcome to the Trading with a Bot channel. In this video we continue to learn about Binance Futures Grid Trading. Imagine this is a brand new Binance Futures account that I just opened, and I had funded it with 5 USDT. Just $5 is enough for you to try out some of the basic principles of futures trading, and for me to explore the topic of minimum required funding when using grid trading strategy on Binance Futures. If you are indeed opening a new account and this is your first time, there's a small tutorial created by Binance, hidden under this menu. In fact, I believe Binance requires you to watch a tutorial video and answer a pop-up quiz before you can start using Binance Futures. Don't worry if you understand just half of it, and answer some of the quiz questions incorrectly. Binance will show you the right answers and will allow you to proceed. I will now choose a crypto pair I want to trade, and as before, I choose only perpetual contracts. Let's continue with IOST USDT pair that I have shown in my previous video. I'll simplify my interface here by removing order book and trades screens. Binance has many configurable components, but in my videos I focus only on those that are relevant to the subject of the discussion. You choose a USDT margined contract pair in the top left corner, as I've shown a moment ago when choosing IOST USDT pair. The next two buttons will allow you to select your margin mode and your leverage. Cross-margin mode simply means that your margin balance will be shared among all of your positions. With the isolated margin mode you can specify the margin wallet size separated by positions. Leave the cross-margin mode if you are just getting started and planning to start with just one grid strategy. Leverage allows you to buy a larger quantity of contracts with a smaller amount of initial margin. Binance allows different leverages for different pairs. For some maximum allowed average is ×20, and for popular pairs it can be up to ×125. I like to use a high leverage because it allows me to trade with very small initial margin amounts. Note: leverage will not impact your profit and loss, P&L. In a few more moments I will come back to the topic of leverage, and demonstrate it with an example. Now that I have gone over some of the key functions of the Binance Futures interface, we can proceed to making a first purchase. Before I open a grid framework, however, I would like to show you some more basics and open a buy-long position manually. Binance offers a number of ways on how you can enter a position. You can enter at predetermined price with a limit order, or you can enter a position immediately at a market price. Or yet there are several more advanced ways, and they all have their own purpose. When trading futures, I want to point your attention to being mindful about your order size. The goal of this overall video is to find the minimum amounts we can trade successfully, and so I wanted to find out the minimum position size I can open. Order size determines your possible profit and your possible loss. The same menu I mentioned earlier describes the trading rules for a given crypto contract, and I recommend giving it a quick look. These rules change occasionally, however, and I'll just use a trial and error method to open the smallest possible order for buy/long position. Order with the size of 50 IOST contracts was rejected being too small, so I will try 100. I am demonstrating this in this experimental way because I think you should also take the time to experiment on small amounts to gain confidence and get rid of stress and fear that may be associated with trading financial instruments. I am going now for an order size of 110 IOST contracts. And it is being accepted. The order is filled and my open position is shown under the positions in the bottom pane. As you recall, I had selected to trade this pair with ×50 leverage, so given the tiny price for IOST contract, being 0.048, and a high leverage that I had chosen, my initial margin was also very small. It cost me only 0.11 USDT to open this position. I can now tell Binance that I want to close this position when the price increases by a certain amount, so that I take a profit. Here you can see my entry price. Remember, I decided I will open this order at the market price, and it happened to be 0.048079. The take profit field allows you to enter a price at which you want Binance to close your position automatically. Naturally, you'd want to put in a higher price if you opened a long position. And that's all there is to opening a position manually. My wallet size was $5, and I opened a small order size of 110 IOST contracts with a times 50 margin, allowing me to spend only 11 cents out of my wallet. And while $5 may be sufficient to open a small long position, you will need more funds to avoid a liquidation, if you plan to open a grid framework. Use the built-in Binance calculator often, and play around with the values, to understand how your results may be impacted by the configuration of your position. Let's cover the leverage again. My entry price was 0.048079 and I purchased 110 contracts. Then if I traded 1-to-1, I would have paid 0.048079 multiplied by 110, which is $5.28, or rather 29 cents, considering the rounding. Let's then say I want to exit when the price hits 0.05. The Binance calculator tells me that this position will cost me $5.29 to enter, and that I will earn 21 cents of profit when I exit. That would be trading with no leverage. But Binance allows me to trade with times 10 leverage, or even more. How much would my initial margin be then? The answer is 10 times less. Note that my P&L does not change. It is only the return on equity % that's increasing. I am getting more with less. Finally, the times 50 leverage is what I used when I opened the long position, a few minutes ago. And the 11 cents was my initial margin. The next important question you need to answer is the following. How much would you lose if the price would drop to zero? The answer is $5.29. And that is independent on what leverage multiplier you were using. In my videos, I speak about price going to zero as the worst case scenario for your long positions. In reality, price may never drop to zero, but it may come close to it, even for a second, due to a technical glitch in your exchange platform. This possible loss amount is the amount that I recommend to hold in your maintenance margin, as a security, to ensure that you will never be liquidated. Let's come back to the main question of this video: what kind of grid strategy can you afford? A few minutes ago I had opened a long position. My account was funded with 5 USDT. As the price went down, the value of my position decreased. My loss remains unrealized, as long as I keep the position open. So, my assets balance still shows as 5.00, but my margin balance is now taking into account the loss that I am experiencing, as the price is going down. And here's a critical moment. The price went down so much that it had exhausted my whole margin balance amount. I have no more margin left. At this moment the exchange will liquidate my positions. That means my loss will be realized, and my assets balance will be zero. And I will also lose my open position. But let's say my initial assets balance was higher, instead of $5 it was 7, and thus, I still had some margin balance left. And now, the price had recovered, and is increasing. I had avoided the liquidation, and I am looking at making a profit. I will close my position, and my unrealized profit will be realized. I managed to prevent a full liquidation of my assets, by having a sufficient margin balance, even for an extreme situation, when the price dropped down to zero. I use the worst case scenario of price dropping to zero to calculate the worst possible P&L. This is the minimum margin balance that I want to maintain. When we're grid trading, each of your grids is going to be potentially an open position. Naturally, the possible loss will be smaller with each grid, because you will open each of them at a lower price level. The sum of all possible losses is the amount you should maintain in your margin balance. Let me say this again. Your margin balance should be sufficiently large to cover the sum of all unrealized losses for all of your open positions. Let me go back to Binance now and set up the smallest possible grid I can afford. At the moment I have about $5 of assets. It's not going to be enough to manage the risk of liquidation, and I will perform the calculations shortly. Please see my previous video, where I described my strategy for grid trading, to understand the principles I use for the grid setup. In short, I set up my grid framework so that my upper price is always slightly below the last price. My next three inputs will impact the size of my positions, i.e. the quantity of IOST I will buy per grid. The quantity will be calculated automatically depending on the overall grid range, limited by the lower price and upper prices. The number of grids I decide on, and the initial margin I will allocate. Geometric mode means that the space between the grids will be the same. Let's play around with these inputs. Let's say I want my lower bound to be 0.04, and I want to allocate 1 USDT. Remember, I am trading with times 50 leverage, so this is equivalent of 50 USDT of total investment. Given the upper and the lower price bounds and the initial investment times the leverage, my order size turns out to be 1,237 contracts of IOST. Now I can enter the number of grids I want, and my order size will be split. This value shows the number of IOST contracts I will buy per grid. And, when I split the range between my upper price and lower price by 10 grids, I will end up with 1.76% of spacing per grid. You must remember what I had shown you before. Each grid may be potentially an open position, and each position may end up having an unrealized P&L. Given my small wallet size, I will reduce the number of grids to 3. Look how the profit per grid percent, and quantity per order values continue to change, as I continue to adjust the number of grids and the lower price values. I have a 10.91% space between the grids, which I consider meaningful for a very volatile market, and my position size is now 300 IOST. If you recall in the beginning of this video, I had established that I can buy even a smaller position size for IOST. So I will now reduce my initial margin amount, to reduce my position size. My initial margin now is $0.50, the quantity had changed to 150 IOST contracts. I believe this is as small as a grid framework can meaningfully get. Let me now press the Create button. Before confirming the creation of the grid, I had again verified to see if the last price had not dropped below my upper price. This is an important element of my strategy. I do not want to open a sell short contract. Once the framework is created, I go to verify that I only have the buy long positions. Grid strategy is in effect, and I am waiting for the price to drop slightly, so that my entry grid position is opened. Switch to the Trading View tab to see the grid lines, in the same way I am seeing them on my screen. Let me do a close-up of the price, by switching to a 1-minute view. While we're waiting, I want to point out something very important. When I was setting up this grid framework, I had set up 3 grids only. But if you noticed a moment ago, there were 4 long positions, and also 4 green lines. I call the first grid, an entry grid. It is an initial opening position, which is not really a part of the automated grid framework. If it's triggered and the price will continue to go up, I need to manually close the grid in order to realize the profit. And, we will also need to take this extra grid into the calculation of a possible loss. I need to cancel this grid framework now, and recreate it again, with the upper price to be closer to the last price, so that it gets triggered faster. Let me speed this part up. Now, it is triggered. My so-called entry grid is triggered, and the first buy long position is opened. I now need to pay close attention to my margin balance amount, and as I have explained, it will fluctuate depending on the unrealized P&L of my positions. The $4.99 that I have here now, will not be sufficient to prevent the liquidation, in case the price will drop down considerably. So let me calculate the worst case scenario, and to find out how much maintenance margin balance I should have for this particular grid strategy, in order for me to completely remove the risk of liquidation. As in my previous video, I calculate the possible loss for each grid in each position. Again, remember, even though I've specified 3 grids only, an entry grid should also be counted as a position. So, 4 potential positions. The size per grid, per position, is the same. The next step is calculator. As I've shown you before, I put 0 as the hypothetical exit, that is my worst case scenario. And, I record these worst case scenarios for each position. And now, I will add them up. $24.6 USDT. This is the amount I should have in my margin balance, if I want to leave this grid strategy running through the night and sleeping well. So now, I need to decide if I take the risk of losing my $5 that I had transferred to my futures wallet, or if I transfer additional $20 to remove the risk of liquidation. I hope you had enjoyed this video and will try to apply what you had learned. If you're just getting started with futures, I recommend a very small grid strategy with small order sizes, small number of grids, and a minimum of $25 balance. And if you don't have a futures account, I invite you to open one. You'll save 10% on your trading transaction costs, when using my referral link, which you can find in the description of my videos. Hey, thanks for sticking around till the end. I know it was a long video, and you rock for having the patience, and the will to learn and improve your knowledge. Please leave me a comment if there's anything that you'd like to ask. I usually respond within a day. Thanks again.